Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. My name is HarveyBracken-Smith, and today I'm honored to be joined by Robert Carras. Robert is the Chief Investment Officer and Partner at Gutmann. I'm incredibly excited to have Robert on today. I've been following him on LinkedIn for a while, as I'm sure that many of you have been as well. And he's had a remarkable career that I'd love to delve into today, his investing strategies, how he thinks about life, and yeah, I'm incredibly excited. So, Robert, I wanted to get started today asking you a simple but important question, and that is, how did you get into investing?
Great to be on your podcast. How did I get into investing? It's been a long time ago. End of the 80s, I just finished school, and there was a big bull market going on in Austria, in the stock exchange, Vienna Stock Exchange. One of the persons responsible for it was Jim Rogers, who was quoted in Barron's, and he said, Vienna must be one of the cheapest exchanges in the world, blah, 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 blah. And so that started a big bull run, and I thought, oh, that's cool. So and people were talking like, at the end of the bull market, it's not I'm a long-term investor. It's more like, what warrant can I buy on Monday to sell on Friday and then cash in and have a big party on Saturday? And being a young man, I thought, oh, that's great. So everyone else goes off working, studying, and I'll play the stock market and get rich quickly. So that was the idea. I got the virus there. Didn't exactly work out like that, but that's how it all started.
So you go in, bull market, get rich quickly kind of mindset. I think we both know what happened back then, but also I think that's the thing that a lot of people, particularly in my younger generation, look at with social media. You see people with flashy cars, with flashy watches, selling courses. There's this expectation of getting rich quickly. Is getting rich quickly, is that a means to wealth?
Yeah, I mean, you know the answer anyway. And it's funny that at the annual meeting, I think Warren Buffett gets asked about that like every 2 years by a very young person, sometimes even children, and he always laughs at it and says, oh, I see you want to have what I have, so to speak, but you want it faster. But the thing is that compounding just takes time, and these get quick rich schemes never work. They only work for those that sell the courses that you mentioned, but that's not the path to take. For me, it didn't work out well, because very shortly after I got in, the bubble burst and there were no profits left. There were only losses left. The only good thing is, if you do it very early in your career, you still have time to get back on track and to recover from your losses. It's much sadder if let's say you're in your 50s and you sell your company and you think, now I'm playing the stock market, and you lose it all. That would be a disaster. But as a young man with little savings, that's a different.
You mentioned a lot of your friends would go out on the weekends, saw the stock market is a way to, in your own words, get rich quick. Buy stock on Monday, sell on Friday. Suddenly this crash happens, as you've just talked about. What do you think made you decide, you know what, actually, I'm going to thug it out. I'm going to learn. I'm going to grow. I'm going to learn the power of compounding, versus simply just, hanging up your cleats and moving on to something else?
It seems that I've been a slow learner. You had to hit me over my head a number of times till I pivoted and really became a long-term investor. But it's also, I guess, we are different stages of our lives. And the funny thing was, back then, the Austrian options and futures exchange started. It was really a non-starter. It only was interesting for a few months, and then liquidity dried down. So it was not really a success story back then, for a number of reasons. But I was one of the founding market makers on the Austrian exchange, and we were all trained by a company called ITI, International Trading Institute, that was owned and run by a guy called Tony Saliba. And Tony Saliba was featured in this book Market Wizards by Jack Schwager. And back then, that was a famous book. Everyone who wanted to get rich in the markets read that. There was a part 1, part 2, and there were people in there, I think, like Druckenmiller and Soros and Bruce Kaufman of Cax. No one knows these names anymore, but back then they were famous. And he was featured in there, and I read Market Wizards and said, oh, that's so interesting. So I more went down the futures trading route. So I did a lot of different things in the markets, but I was also always interested in equities. And at some point, I really wanted to have a different lifestyle, because when I was trading futures, for example, and I also had my own firm at one point in time where I had a global market futures fund, would you believe it? And I got up like 2 or 3 in the morning to look up the Japanese markets and see where they are trading. So it was a crazy lifestyle. And now I'm really super inactive, very long-term holder. So I guess we always move between extremes and try to find our path. And I think that's a story that never ends because we always change. So our investment style also has to change. Maybe I'm too inactive now even. So maybe I should be a little bit more active also. So who knows? I'm still evolving at my old age.
I think it was Warren Buffett who once said that if you get like a card with 10 stamps or 20 stamps throughout your entire life, and they're the only, you maybe have like 10 buying opportunities through your whole life, and you just stamp those, buy it, hold, you'll be much more successful than all the little things. So I think that you probably are doing the right thing.
So I like that the story that he tells there because what it means is that knowing that you only have these 10 trials or these 10 opportunities to do something, that means you will do a lot of work before you get into action. So you will prepare carefully and you know that you probably have to hold then or live with that decision for a long time. So it gives you a different mindset. So it's not like, oh, I got some blinking message from Robinhood, buy, sell, buy, sell. So there you'll really do works for weeks and months on end before you then pull the trigger.
I'm a big believer in this concept of experience through doing versus just experience through age. So I think there's a lot of people who, might be 50, 60 years old, but actually have only spent a few years in the market. So I wouldn't call them that experience, but you could have a 30-year-old that's been following the market since they were 12. The reason I mention that is I think growing up, I've always had a keen interest in the markets, trying to understand what's actually going on. And in recent years, actually trying to put money into the markets. And that's a different learning experience in and of itself. But I think in 2021 was a really good example of this idea of the metaverse, of NFTs. You see these cryptocurrency valuations going sky high, and then they obviously plummeted. Now it's this age of AI. You're a long-term holder. How do you balance a lot of noise? Everyone's telling you this is going to be the next biggest thing versus actually finding the signal and the value.
So you touched on a lot of things here and a lot of important things. And I want to go back to the beginning of what you said, because I really love that you say it's not the age that gives you the experience, but it's the doing. If you've never had any experience in the stock market and you start at 50, why should you know more than a 20-year-old? So that's I really completely subscribe to that. I'm just thinking about our CEO and also part of the owner family of Gutmann. He's in his early 30s, and you say, oh, he's so young. How can he be CEO? I think because he has thought about it and done a lot of work at a very young age. And I'm 57 now. And I go to him and say, oh, let's do it this way or that way. And then he said, oh, why don't we do it this way? Have you thought about this? And I think, oh, he's actually right. And it's a bit embarrassing for me. But it's also cool. I mean, I find it fantastic. And I meet a lot of young people. And I think wisdom, experience doesn't have to do with age. So you can learn from any age. And so I'm in no way arrogant. Old age means nothing. I mean, there are super smart young people and there are super stupid old people. So who cares about the age really? But you talked about noise and signal, and that's extremely important because there's so much noise now. There's always been noise, but now it's extreme. You cannot take your device. There's always constant noise coming at you. And I think on the one hand, you have to be up to date. I mean, as you said, you touched on COVID. So we all had to become experts in that one. Then there was Russia, Ukraine. So you have to be like a military expert. Then there was renewable energy was a topic. So you had to learn on that stuff. And now it's probably AI. You have to understand what are these large language models doing? What is the energy complex? What's the role there? Blah, blah, blah. So we have to go up that learning curve, and we really have to run to stand still. But then I think we have to also step back and take our time to go deep on subjects. And for me, it's still reading books and printing out stuff and doing it on paper, because I have to then go into a room or in the evening, be in bed and read that stuff, and I don't want to do it on the device because we are now all biohackers and we know the light is not good for your sleep quality. But it's a different modus operandi. So I like to read it on paper. So we have to take that time to also go deep on the subject. But it's a challenge because you have to be exposed to a certain amount of noise to not miss where the world is going. But for example, I completely stopped reading what used to be a newspaper, but I I didn't read newspapers when there were still newspapers, and people say, "Oh, how can you do it? How do you know what's going on in the world?" But then when you look at people, they read their local newspapers. So you're in London, you read your local newspaper. Someone in Paris reads a different newspaper. In Austria, someone reads a different newspaper. But what's the purpose? Because you go to the office and you want to have the chit chat about what's going on today in your local community, blah blah blah. But is it really so important? I always say, the news will find me if it is really important. I want to choose what I read. And I like to read long form Substack by authors I have known and I trust, and then I go deep on a subject, much more worthwhile for me.
Sure that your process is a lot more refined than mine, but I actually do something similar where I think a year or two ago, I went on my phone and every single app, aside from emails, including news actually, I turned off every single notification as I found that I was going through every day, and no matter what I was doing, whether having an important conversation or even just going through life or taking a walk through a park, you get another notification, breaking news, another, just nonsense thing coming on your phone. And when you actually pay attention, you look how many endless things are taking your attention in a day, it's pretty crazy like what it does to your mind. So kind of since doing that, I mean, if I've got an important email that I'm expecting, I'll respond to that pretty quickly. But I now, aside from that, like more personal messages, unless it's urgent, I'll respond to them in like the start and the end of the day. Similarly, I'll read the news in the morning and in the evening on select publications. But I found that for me, it's enabled me to look at the news critically instead of just being reactive to it. Because I think when you're reactive to constant streams of news, it changes the way that you think. And in a market where everyone in the world could be telling you this is the most important thing, such as when we had NFTs, for example, which are clearly, in my opinion, you might have a different opinion, nonsense. It's very hard to be able to have that level of critical edge.
Yeah, definitely. Way to go. That's what you should do. I mean, I turned off all the sound notifications a long time ago because it's not good for your blood pressure, because every time there's something, your blood pressure goes up, and so you don't really need that. But as you said, you want to choose what you want to look at and not be chosen by some app that wants to sell something to you at the end of the day. So I think that's a very smart move.
So because you mentioned that you're a long-term holder, you make very little moves. Do you find that you're initially, when you see a new technology, new company, device, area, I mean, maybe there are less new companies because you're investing for such a long term, but maybe a new product, do you find that you're more of an early adopter in your business or for yourself personally, or you're more skeptical at first, or is that too hard to pick one or the other?
I think I'm clearly an early adopter, because I'm always so interested in the new thing. So the book, Michael Lewis wrote a book once that was called The New Thing, resonates very strongly with me because I'm always excited. I'm also the kind of guy, if I find a restaurant or if I find some food that I like, it's not that I eat it the rest of my life. I'm not like Warren Buffett who likes burgers and steaks and never switches from that and have his Coke. I always want to try the new thing. If something opens up new, I want to experience that. I want to see how it is. So that's just my personality type, I guess. So also on the technology side, I've been very early to use the LLMs and play around with it, for example, and other stuff. So I'm always trying. And that's also why I like talking to young people, because often they see things that I don't see because I'm not plugged into the community, so there's a lot to learn there. But on the investment side, I've been very slow to really understand how the tech companies work many years ago. But then when I came to Gutmann in 2019, Christoph Olbrich, who's running our equity team, he's very interested in technology. He's always trying and understanding it very deeply, how it all works together. So the whole chain that is necessary to run certain technological products. And I learn a lot from him. And now it's much easier for me because I've have this constant exchange with him and learning from him. You also need someone you can learn from, and then at some point you know enough, and then you can find your own sources to go further and then check back and see how do you see that, and then you have an educated conversation. So I'm very interested in technology. It's very tough to invest in the area, and just looking at Alphabet this year, if I look back, what the narrative was in April and what the narrative is now, and the stock went up like 120% from the low. So you see how difficult it is for everyone to understand, because for the fourth biggest company in the world having such a large price spread, that also means that the information is constantly flowing through the markets and everyone trying to understand. It's very difficult, and there's not the one truth. It's all evolving. So you have to be careful what you pick and where you really want to take a position. But I think if you say I'm not investing in technology, that would be stupid, because it's such a big part. Everything is technology, everything is touched by software, so you have to have knowledge about it.
I heard a very interesting piece of advice the other day from a hedge fund manager called Stephen Roberts, and I've often interviewed him sort of once a month, and he's talked about we've done more markets focused podcasts rather than more career journey learnings lessons like we're doing now. And a really interesting piece of advice that he was telling me is, when you get all of these skeptics for the Magnificent Seven, for example, and they're saying, oh, they're overvalued or they haven't done well, he's like, well, just go look at the returns from the past 10 years and tell me that you wouldn't have wanted to invest in those companies. And sure, there's an extent to which valuations can be high. Sure, there's an extent to which can be skeptical. Sure, there's an extent to which there might be an AI bubble that people keep talking about right now. But if you're talking about from a returns basis, many of those people that were so skeptical that never got involved with those stocks 10 years ago, their investors would be very happy if they'd actually invested in it. So I think it's both about being skeptical, being interested in worrying about the risks, but also about finding out which of these companies are going to deliver returns, because the Mag 7, don't know if it will continue to do as well, but if you look back, the past 10 years have done significantly better than many of the 493 other stocks in the S&P, for example.
And what really has changed is that now, if you want to follow a certain view, let's say you say, oh, I think that the Mag 7 or some of those stocks will do very well, and you search for that, and you go on social media and you do all kind of things. Or the opposite, you say, oh, it's a bubble and maybe it's overvalued. The algo will serve you up more and more of the same. So you easily get in a very narrow bubble that confirms your thesis. So you have to be very vigilant that you form a thesis, but then try to say, oh, but what's the counter argument? So what would I say if I would be short or long the idea? So I think that's very valuable. I think that has always been a danger, but now it's even worse, because we all notice it when you go on whatever platform, may it be LinkedIn or Instagram or X, you'll get served the same thing over and over. The algo very quickly notices if you're interested in tennis or golf or skiing or investing, whatever, you get it very specific content. So confirmation bias is, I think, one of the largest dangers still.
How do you go about avoiding confirmation bias?
It's very difficult, but I think it all starts, I can only say for me, so I come across a business model that sounds interesting, or someone is pitching a company, and then normally that presentation is done quite well and with all the positive aspects, and you get like FOMO emotion coming up, say, oh, that sounds so great, I have to have that stock. And then I think what I do first is look at the investor relations presentation, so last quarterly presentation, so just to get an idea. Then you maybe want to have a quick read through the main parts of the annual report. And just by doing that, a lot drops off immediately, because you recognize, oh, it's not as easy as the person pitching it told it. There are a lot of question marks, or maybe the business model is quite difficult to understand. So I think 90% already gets uninteresting just by doing a little bit there. And nowadays you can obviously use AI for all kinds of things. You can do your deep research, and then you can very specifically prompt it to critique the thesis. I do that a lot, so also for my writing or my posting. I hate AI writing, because I coined the term, it sounds like elevator music, so you somehow hear it in the rhythm, it's just boring and it's just something wrong with it. But I always tell it, critique me. What's wrong with my thesis, critique my writing, and then if you're ready and if you give it more information, then it will be quite tough on you. It will be tougher than any of your friends will ever be, because they will always sugarcoat it. But if you ask the thing, then it will tell you, oh, that's not you, that's just generic speak, that's super boring. So you're like, okay. So it really gets you thinking. You just need someone to tell you you're full of crap, think again, and that already helps you to have a different view on things.
It seems like quite an obvious question, but an important one nonetheless. How do you think about you mentioned you're a long-term investor, but how do you think about portfolio composition, sizing? Do you have certain sectors of companies that you invest in? What's the sort of process in thinking there?
I actually also had a post yesterday contrasting the approach of Gary Shannon. He's also in London, Phoenix Asset Management, which I admire him. He's just such a great investor and thinker, very concentrated, and to what we do at Gutmann and also what I do. And at Gutmann, I think we have much more of a portfolio approach. The main strategy has 50 positions, equal weight, different themes, and also long term. So, and I think out of the 50 stocks, I have to check the latest number, but when I last looked, it was 18 stocks we have held longer than 10 years. So we really, having been involved with these business models for a long time, and also we also, by the way, have a long time held 5 of the Max 7. So we have been there, but not in the. We don't have 7.5% in Nvidia. We have 2% in Nvidia, and have sold more Nvidia than we hold. So it's a different approach. But here, I think what's really good is for the something like 1,000 clients who have a portfolio management mandate at Gutmann, that it's always a very balanced approach, that you don't have to be afraid of concentration risk. You don't have to be afraid, oh, I'm buying into it now and I have all the past gains, but if things turn, then I will only have losses. So I think I like that approach for most investors who don't want to be bothered with markets, who are not really interested, who want something that they can understand, something that's not taking extreme risks. So I like that approach, and I think it's a very sensible approach. And then for me, myself, because I've held some of these stocks, I mean, I've been invested in Berkshire since 2008. So for me, somehow it came out that I'm an 880 guy. That means I hold 80% in 8 stocks, which is really quite concentrated. And so my outcomes are really different from the market, and that's not only to the downside, unfortunately. So you also have bad years. The more concentrated, the more likely it is to will also have very bad years. But position sizing wise, it's also an evolution, what I found for myself. If you want to be also inactive and be really long term, then you probably have to do larger positions and be more concentrated, because you invest a lot of time to get to know the business models. You live with these business models often for years and years and years. Some of them I'm over 15 years now, so you have a lot of incremental information. You also have an informed gut about the business, because you have been with the business so long that it really it's in you somehow. So you read a new quarterly report and it adds, and you say, oh, that's, and you and the funny thing is, if you read the news about it, like for Berkshire, when on Saturday quarterly report and news outlets write about it, and then you read it for yourself, you say there's nothing really good in the news flow, because they are focusing only on the stuff that they think will capture a lot of attention. So they're all also on a clickbait journey. But if you read it, then you see, okay, there's something else that's much more important than what you read in news flow. So I think as an investor, you have to do your own digging, your own reading. Don't do second-hand sources. Do the primary source. Go to the original source and form your own opinion. Don't bother about the others. But the more you know about the business, the more you recognize that most people don't know anything. They just say they know something, but it's really, deep knowledge is very rare. And there are some investors out there that have much deeper knowledge than I do, and more qualitative approach and systematic and what information they find. But I think my advantage is that being with the business for a long time, you just gather a lot of information. I mean, I know so many nitty-gritty stuff about Berkshire Hathaway just by having been invested for so many years, and paying attention to every word that Buffett says. And I know I'm not alone in the world, but probably in Austria I'm one of the 3 or so that know that much about Berkshire. For my approach, you need to be more concentrated, because what I do, I cannot do over 50 stocks. But there is also a limit to position sizing. So for example, one guy I also admire deeply is Monish Babrai, because he's so concentrated. And I've known him before the financial crisis, 08, 09, and I've been to his annual meeting. Back then it was also in Chicago, so I went there. And so I studied what he's doing, and during the financial crisis, he had a drawdown of over 70%. So it was really huge. And he doesn't take a management fee, so it took him 7-8 years until he earned money again from the fee structure. Amazing stamina also, to not close the fund and keep going. So deeply, deeply admire that. But he, after the financial crisis, he had this elaborate system where he says, okay, I buy 50 cents on the dollar, but for my last 20% of my portfolio, I want to have, I don't know, I only pay 30 cents on the dollar. And for the last 10% of my portfolio, I pay 10 cents on the dollar, and I have this and that. But at the end, I think after a year, he got rid of all of that, and he's now going all in again. I think one of the positions he held recently was over 40% of his funds. That's really huge. But what was interesting is that he said, but I never invested more than 10% at cost ever. I didn't really know that. The way that the position got to 40% was just by performance. And the same is true for Gary Shannon, Phoenix Asset Management, after the financial crisis, or in the financial crisis. They helped Barrett Developments to recapitalize. So they underwrote the capital raise and avoided bankruptcy through that. And they had a 10% position that grew to, I think, 35% at the high. But he also said, never, that's one of our rules. We invest 10% at cost of the funds available in one business. And that's something that also worked for me. I mean, I violated it a little bit when a business came down, and then I probably, if I really put it in an Excel sheet or do the data analysis, then I might have gone to 12%. But más o menos, I think 10% at cost is something that works for me. I mean, it's different if you start out and say, okay, I have 5,000, 10,000 dollars, pounds, euros to invest. Then doesn't make sense to only invest 10%. Then you buy one stock or two stocks. But as at some point, if you invest more than your annual salary and that part grows, then I think the 10% makes a lot of sense. Because you will be wrong. And if you're wrong and you're super highly concentrated, how will you handle a 70-80% drawdown, which you will have? Monish Pabra had a 70% drawdown, and he's super smart. So why shouldn't you have a 70% drawdown? And if you think you can handle it, good luck. It's so devastating. It's so difficult to handle. Even a 50% drawdown, which most of us will experience at some point, is super ugly. But yeah, that's part of investing life. It's a feature, not a bug.
I really liked the thing that you just said about looking at the news and going to the primary sources. So I'm 21 years old. I've got a brother who's 2 years younger than me, and he's just getting into finance. He's doing an internship right now. And he came and he asked me, Harvey, how do I go about reading the news? There's just so much information. And I just gave him some very simple advice. And I was like, go to the Wall Street Journal, go to the FT, go to the Economist, read the headlines, maybe read one or two, but read the main headlines, read the main things going on in the economy, and just spend 5-10 minutes every day and just write down the 5 main macroeconomic points of the day. Just write down 5 points of what's going on day over day. And he's done that. He's like, oh, okay, it's 5, 5, 5. And what he's kind of starting to realize, what I hope he's going to start to realize, is how much just noise there is. Something will be on for a day, something will be on for 2 days, for 3 days, then it'll be gone. But what's still the biggest headline after 3-4 weeks? Okay, Trump's tariffs. Or is that just a thing he's saying or doing? Well, particularly in April earlier this year, adding more tariffs on Canada, Mexico, on China. Oh, okay, Liberation Day. Okay, tick that box. All right, that's a really big thing going on. NFTs are coming back. I'm not sure about that. Monday, Tuesday, that thing's gone. And even just by doing something as simple as what's being said by the people in the news, what is going on for a longer period of time, what's just a random story that they're trying to get viral versus what's actually going on longer term. I have found that for myself, it's almost been like a language unlock just by simply being there, reading the news consistently, not even by doing anything special. You simply just notice these patterns in your head. Oh, this was mentioned a year ago. And so you slowly build up this thesis and understanding of what's real and what's not. I think your point of going to the primary sources is something that I can actually go away and learn as well, because I think news outlets have their own agendas. But I think that that's an important understanding nonetheless when going to people actually putting out the news, of even just looking at how many times a story has been put out as a way to gain understanding.
That's certainly a smart advice you gave to your brother. And he quickly realized that they have to sell news every day and have to write about something, and it's all super exciting, and it will be gone in a few days, and then there's something new, and it doesn't really matter. I still remember a government shutdown in the US. I think 2 years ago I had to do a client information send out, so a one-pager where more or less said, doesn't matter, but I put it very politely and blah, blah, blah. And then where we are today, it really happens. It's shut down for much longer than ever, and no one cares anymore if there's CS. It's just, yeah, it's a strange world out there.
We talked a bit about the drawdowns. You mentioned some of the smartest individuals on the planet had 70% drawdowns, as well as one of your friends who was more concentrated, and it took him 7 or 8 years to get back. Even people like yourself could have the potential to face 50% drawdowns. I think that it can be incredibly hard from an investing point of view, dealing with investors, dealing with the money that you're earning or not earning, your own ego, the things that are going on, the people that work at your firm and trying to convince them to keep going. It's a different thing as an investor because you've put your money into your fund, right? They're expecting returns, at least they're hoping for it. We all have these emotional parts of us where the rational side is saying, for 10 years, don't worry about it, it's going to work. Look at the past performance, look at XYZ, we're in these stocks, they're going to be part of the future. But then they're looking at their portfolio and it's down 30% because of XYZ market conditions. What advice would you give for people putting their money in your fund, or really any people that invest in institutions? What sort of advice would you give them for when they always want to see the up in the short term, but also want the long-term results? How should they go about navigating the emotional brain with the rational brain?
I think super important point on the emotions, because if I break down our business model at Gutmann, I think the core is really to help people to reach their targets during the difficult times. Because if everything is going well, then yeah, you advise and you talk to them and so on, but it's everyone, in my opinion, can do it. And then it really gets more difficult when markets go down, when panic is out there. You prove your worth also as a client advisor. I think with all the instruments, with all the technology we have, people can do a lot themselves and very cheap with the whole ETF industry. You know the narrative out there. Just buy an index and don't worry about the rest. But the biggest danger is not the market or the selection. It's always the people themselves. How will they react when things get ugly? And people underestimate their own reaction. They cannot envision how they would feel like. And if you read the studies also, I think I read somewhere that losing money in the market feels like being robbed. There's a gun pointed at you and say, give me your money. That's the same way people feel when they lose money in the market. And these are very strong emotions. Our crocodile brain is jumping into action, and we want to make the pain stop. So that's I think that's the biggest topic out there, how to avoid stupid action during those times. Because what happens is that you start investing, you put the money to work, then something really difficult happens, like the financial crisis 2008-09, or coronavirus, where the stock market quickly tanked like 30% or so, and you panic, and you probably at the low point, you can't take it anymore, and you get out. And then the damage is gone, because what I've seen in all these crises, that amongst 1,000 clients, you'll have a handful who are like that, which is amazingly low in my opinion. So I think, and that speaks to the work we have done before, because I always talk about the negative things that could happen and try to prepare people. And then I can say, oh, we have talked about that, and now we're in the middle of that, but most of them are not 100% equities anyway, so we chose a smaller percentage, and I know you can handle that, and so we go through that. But a few of them, they just throw in the towel and get out. And the interesting thing is they never come back, or come back at new highs much later. So everyone thinks I can go out now and I can come back tomorrow, but they never come back. They never invest again, because it's either going down further, then they say, oh, my decision is confirmed. I knew it would go down further, so I'm so smart, I sold. And then it goes up, and then people say, oh no, shall I now buy back higher? I don't want to do that, because I sold at that price and I want to buy at the same or at the lower price. So they just watch going it higher and higher and never get back in again. So, and I'm not the first guy to say that. If you read Phil Fisher's book of the he says exactly the same thing. Not 1 in 10 will be able to buy back at the same or at a lower price. So I think these are the largest dangers, and there's not enough focus on emotions and not enough focus on human behavior. I mean, there's much more than there used to be, but there's a lot of discussion. What index should I pick? What ETF should I pick? What strategy should I do? Shall I be a growth investor or a value investor, this or that? But at the end of the day, it's really, who are you, and what will this do to you, and how will you behave is much more important, in my opinion.
What were some of the things in theory that you thought would be a problem or thing that you'd have to get over, maybe emotions or whatever, before you started in the world of finance? And what are some things that you've had to get over having actually been there? Like, what are problems that you wouldn't have known you would face if you hadn't have gone through the years of training and being in the market and getting into the position that you're in now?
I think to get to a point where you feel comfortable and you find something that works for you, it also means trial and error. You have to try things out. Because if you think that, oh, it should be easy to make money in options and futures market like I did, it's no use to say, oh, I know, I've read, you should be long-term, blah, blah, blah. I mean, you have to try it out for yourself. And also saying, okay, I read Buffett and he always says you have to buy and hold and be in there for the long term. But it worked for him, but it doesn't mean that it worked for you. So I think it's really trying out with low amounts of money. I'm also no fan of paper trading. Paper trading doesn't work because you don't feel that you lose your treasure. I mean, if you have your first $5,000 on the side and say, okay, now I'm going to invest it, and if you lose 3,000 of it, you'll feel it because you suddenly think, oh, that could have been a nice vacation or something else. So you have to feel the pain, and it's painful. So you have to try it out, and why not try out also the futures markets or try out short-term trading? I mean, I did. I remember many years ago I had an account with Interactive Brokers, and I was doing short-term trading. What today high-frequency trading computers do, I tried to do manually. So I was like the market maker and playing around with that. And what I noticed is that the payoff is very similar to option selling. So you have a steady income, and then something hits you, and then you have a big loss because the market moves in one direction and you get filled on all your orders, and suddenly you hold a position and it goes against you. And if you do that for a number of months, you notice there's a certain payoff profile. And then you say, okay, so you already have to understand options to understand what is a short option profile, what is a premium selling profile. Because these are strategies that you will come across in your life as investor. And at some point you notice, okay, everyone who does premium selling, option selling, volatility selling, they have a very smooth and steady track record until the day they disappear. And I don't know a single one that says, oh, I have a 10-year track record, I have a 20 years track record of option selling, because at some point they all get killed. So it's important to understand these things. And I think my biggest part in my role as a chief investment officer is to say no to almost anything, because I've seen a lot of things. And if you don't know these things, then always some things always look interesting and new and shiny, but there is not really anything new. It's always coming down to the same mechanics. So it's important that you understand what you get into.
In that case, then, how do you balance you mentioned that you're an early adopter, so you like new and shiny things. How do you balance that with the other part of you as the chief investment officer that's got to say no? And a subset of that question is, what is actually the catalyst or thing or breaking point that will make you decide to get out of one position and enter into a new investment opportunity?
So I'm very interested in anything new when it comes to technology, when it comes to food, when it comes to an experience that I haven't had before. So I'm trying to see how that is. But it's different in investing. In investing, I'm super boring. So this personal trait of mine doesn't translate into investing. So I don't have to invest in the newest things. It's just the opposite. And especially product-wise, in the investment field, I'm super skeptical of everything. So my assumption is that whatever you want to show me or you want to have to offer me, it doesn't work. So I think it's not a bad assumption to think it doesn't work. Prove me that it works first. So I'm not interested in complexity. I think because everything that's new and different always comes also with complexity. And it's like complexity in finance is like creativity in accounting. You don't want to have that. I like to keep things simple. And you know the old saying, you should only invest in things that you understand. It still stands. It's still true. If you then read about business models, and often they're in the technology space, and you read through it and you have no clue what it's about, how do they make money, then be careful. I mean, even with OpenAI, I can talk about OpenAI. They are not a public company. I cannot invest. No one is invested that I know. Someone certainly has to be invested, has given them money. I think what I heard, the last round of 6 billion from Microsoft puts it at 500 billion market cap or a capitalization number. So it's a big number. But then if you try to understand how they make money, for me it's very difficult. What will be the what will be the business model. But there are also other people who say, oh, you have no clue. First, they will have all these users that are addicted to it, and they'll find a model how to monetize it. And it has been true for a lot of companies, especially in the software internet space, to first get the users and then find the monetization model. But I'm very skeptical because if I don't like ChatGPT, I can move to 4 or 5 other LLMs that now might even be better with Gemini. So you get a lot of ratings where people like that more. I certainly like that more for generating pictures. Today for a LinkedIn post, I generated a picture of myself as a knight, and it's scary. It's scary. It's me. It's not some guy looking kind of me. It's me. It's really strong, these models. So I think, yeah, use all the stuff, but when it comes to investing, be very careful, be very skeptical. Don't believe anything. Assume that everyone just tells crap. So be different when invest.
Do you think investors of 50 years ago would have imagined that they'd be posting photos of themselves with an AI-generated knight on a horse?
And even if you're 10 years ago or a few years ago, wouldn't have believed it, because when you look at these old computer ads, they already talk about artificial intelligence, and there will be some artificial mind out there who can do what we do, and then for like 50 years nothing happened. So why would it have been different 2 years ago or 3 years ago? But now it's here, and it's working, and it's just amazing. And I'm paying for 3 models. It seems that the subscription price is not enough to cover the costs. Cost is coming down. Yeah, maybe there's a business model out there. I haven't seen it yet, so I'd be very, very careful. But it doesn't matter because you can't invest in OpenAI anyways. There are only a few others that have. I mean, that's also a differentiator to the internet bubble end of the 90s. I don't know if it is a bubble or not, doesn't matter. But there are only a few companies that really have a direct connection to the whole trend. I mean, biggest of them obviously is NVIDIA. But even there, now with Google, with the Tensor processing units, might there be an alternative? And I guess there are many Chinese also working on chips that can do tremendous things. So people always underestimate how competitive the market is and how creative the human mind is, especially if there's a lot of money to make, to find alternative products that are good enough to disrupt the monopolist.
I think the point that you're making now links quite well to a point that you made earlier on, in that with regard to being skeptical, but also about with regard to your investors in your fund. So if they have money in the fund, they take it out, it goes down, they think they're correct. If it goes up, they're like, why didn't I buy in earlier? And I think that's really important with what's going on with OpenAI, because as it keeps going up and up and up and up, on the one hand, people are saying, oh my God, it's doing so well. On the other hand, people are saying, it's too big. I actually think I have an interesting perspective on AI. It's not necessarily a unique perspective, but an interesting perspective nonetheless, because kind of, as I said, the 2 biggest waves for me, I mean, of course, there's been, COVID, what happened with Liberation Day, but 2 things that I've taken a particular interest in. One is this massive AI bull market in private companies, and the other one being the NFT and crypto market of 2021. The reason I find both of those really interesting is in 2022, I actually took a gap year, and I was working at a venture capital firm for 4 months. And similarly now, my podcast, I've spoken to a lot more venture capitalists, and of course they're in the market of make 50 to 100 bets, 1 or 2 of those pay off outsized, they do really well. So kind of a different mindset of things. But both in that time, not at the firm that I was working at, but both at that time and now, speaking to a lot of people on my podcast and outside of it, I've noticed that about crypto, about NFTs, and similarly about AI, a lot of these similar investors, even FTX a couple of years ago, they are raging enthusiasts about these things. It's going to change the world. It's going to change everything you do. It's going to change how you talk, you walk, you eat, you live, you spend money. And it's like, maybe it will, but are you guys pricing in this for OpenAI, for example? Sure, they have 700-800 million users, but they're pricing in, as you said, a $500 billion valuation. HSBC released a report the other day saying they're going to need to burn 200 billion more in the next, up to 2030. And it's like, this seems to me an extremely optimistic scenario, but that extremely optimistic have been priced into what they call the base case. Like, it almost seems that OpenAI keeps getting these ultra high valuations, but it's the presumption. It's not like if da works out, maybe, price it in or let's see. It's no, the expectation is every industry from finance to healthcare to childcare to eating, whatever it may be, is going to be changed. And I am all for, this big revolution, and I'm excited for it to happen. And I'm sure, like in the dot-com bubble 25 years ago, that many things will change. But I'm very skeptical that everything will change, particularly as I said, I keep hinting in this podcast, my youthful mind, just being in the markets, I have seen the big, without naming names, the big venture capital firms, the big hedge funds, the most influential people on the planet that I look up to, say, this is going to be the next biggest thing, this is going to change the world, you need to buy now, it keeps going up, only to be not burned, but to see it go and crash and not work out. So quite a long way of saying that I'm excited for the future, excited to be an adopter, excited to learn, but I'm also skeptical of people, even if they have all the credentials in the world, saying something is going to work, because it doesn't work out like that. And I think it can actually be really dangerous to the average person who's not in the market, who's not invested from a sophisticated level, to hear these things from the people they look up to, because it could just be pushing up the price without actually any real value there.
And that's the last thing you said is I think most important, that if the so-called influential people say that's the next thing or that's the future and you have to be invested, they certainly already have a position, and so they have an interest for it to go up, and then they maybe cash out on it or book the profits there. So you always have to look at what is the incentive, and the incentive is mostly to keep the thing going, and then if it reaches you, you're probably one of the at the end of the tail, getting on the train, and normally it doesn't end well. Yeah.
Quite unique thing about the stock market, same with venture capital or running any sort of fund or anything, is that no one can truly predict the future. We can have strong estimates, we can look at the past, we can look at the financials, we can predict things out in sophisticated valuation models. But at the end of the day, anything can happen. Would many people predicted COVID? Maybe you did, Robert, but I don't think most people would have been able to see that happening. The reason I mention that is being a kid, I think your parents always want the best for you. They might have a lower risk appetite. They want you to go to a good school, go to a good university, get a good stable job. But I think in the world of investing, you've got to have some form of appetite to risk. My question is, when is a good time to go about going from investing within a company, within a bank, within a fund for someone else, to going about starting your own fund or starting to take investor money, point in time good? Is it a time in the market thing? Is it you have to work at a top firm beforehand? Particularly, I ask this question particularly on the basis that even people like yourself who have reached the highs of the investing world, or many of the idols that you've mentioned before, still face years where they lose lots of money and don't necessarily recover from it.
Yeah. What's the right point in time? Charlie Munger always liked to tell the story about Mozart, Wolfgang Amadeus Mozart, who was approached by a young person saying, okay, I want to write my own symphonies, I want to play in the opera, and what is the right time for me? I think I'm ready. And he says, oh, no, you have to study another year or two, and then we'll see where you are. And then the person says, but you already wrote symphonies when you were a small kid. And he said, yeah, but I didn't have to ask anyone. So I think that's I think when are you ready to go out on your own is whenever you're ready, and no one can tell you that. I've seen people who have tremendous experience, tremendous pedigree coming out, for example, of Goldman, already starting with $1 billion or something. But I've also seen people in their 20s sit in their parents' home, starting with a small account, talking about it and building from there. And some were even successful with that, not knowing anything about the world out there. Don't even know probably how a stock market really functions and what is a clearinghouse and blah, blah, blah. But they don't have to. They just focus on their niche. They don't care. They just do it. So there is no answer to that. But what I can tell you, I mean, I've had my own company once, and I ran a fund for 2 years. The company ran for 3 years. They closed it down again. That first of all, that I think that the toughest part is always getting outside money, because you have to have some people who believe in you and trust you and say, okay, Harvey's a young, smart guy. I give him some money, and it has to be large enough for you to also finance the structure. That's the other problem, especially in Europe. It's very tough to start a fund with small money because you have such a big burden of regulations. Everything is very expensive. It's, I think, still easier in other parts of the world. But there are a lot of variables and a lot of hurdles you have to overcome. But no one will tell you this is the right time and this is the way you have to do it, because again, you have to find your own way. And if you don't see the way, then you're certainly not ready. So you have to dig deeper and you have to know something about something. You have to be knowledgeable about at least a very small area where you have the conviction, you can be good, you have a positive expected return, you feel yourself ready to manage other people's money, because that's a large responsibility. I now have the self-confident enough now to say, if you stay with me, if you trust me, we'll come out ahead. But I cannot force people to behave. It's still behave in a certain way. It's still their money, so I have to convince them, even seduce them to do certain things. Cannot force anyone. But if you do your own fund and your own business, it's much more difficult, because you have to do every little thing for yourself. And what people do underestimate is the little things. The little things really add up. So yeah, there is no easy answer to your question, I'm afraid.
I'd never heard the quote from Mozart, but I'd heard a new rendition of it from Elon Musk, where a young person asked him when to start business, and he said, if you need motivation to start a business, then don't do it. And I think it's very similar. In fact, maybe it's even an exact copy of that sort of quote, because when you think of many of the greatest investors on the planet, many of the greatest individuals, there was never actually a point in time when many of them were going to someone else, should I do it, should I do it? Many of the geniuses actually did it straight away. Bill Ackman started his fund straight out of Harvard. Ken Griffin started his, in university as well. And I actually think it's something that I've been dealing with in my own life and trying to understand, because when I try and speak to people about how I should live my career, how I should live my life, many people tell me, go and work at this firm, go and do XYZ thing, then do XYZ thing. And it just seems, and I'm like, all right, well then I'll be 70 years old and I will have lived my life. And that's not what I want to do. And even when I tell people, I'm like, at the end of the day, the biggest fear for me is, and this sounds a bit cliche, the biggest fear for me is not losing. I don't mind if I fall on my face and fail. My biggest fear is not having tried at all. And so I've kind of got this thing within me that's telling me, go try it, go win, go succeed, because I know that I'll work my ass off, I'll do everything I can to win and to do the best I can. But on the other hand, I have these voices of people I look up to, and they're like, oh, just do this. And then when you've done this, you can do this. And when you've done that, you can do that. And I'm like, all right, well, I may as well just not, So it's a very maybe it's the youthful naivety and determination and strength and everything that I believe that I can bring, aside from the experience of people that haven't necessarily achieved great things. Someone else once told me, and I thought this was really good advice, was only take advice from people that you want to be like. I think that we all often take advice from family and friends and, people, but, how many people in your business, for example, how many people are there actually running a fund? How many people that have actually succeeded or failed in the investing world versus the friend, the partner, the ex, whoever it may be that is giving you this advice? And I think that's a very important way to think about things.
Yeah, I like that. I like that approach. I have to remember that. That's a good one. If you only take advice from people you want to be like, that's a good advice. And I mean, even you're doing this podcast. I mean, there are people out there asking, "Oh, shall I do a podcast?" There are so many podcasts out there. Do we need another podcast? And here is a 21-year-old Harvey. He's just doing his podcast. Traveling around the world virtually and talking to people and learning and sharing, and you're just doing it. And by doing it, you learn a lot. I mean, I'm posting on LinkedIn every day. That's one of the things I do. Then you learn things that you cannot learn by being told by others. You have to do it and experience it, and then you say, okay, this is this, and then. And you underestimate things and you overestimate things. You have to get going, and you have to do things, and yeah. I can only agree with you.
I think you may have answered your own question there in terms of my next question, but why post on LinkedIn? Why post on all these social media platforms? Why share the secret sauce?
So first of all, there's no secret sauce to share. Unfortunately, I'd like to have a secret sauce. I don't. I don't know. I always had this Sendungsbewusstsein, so I always had the urge to tell the world what I was thinking. So I have this newsletter, Gutmann Viewpoint, in German and English. I've published that for the last 6 years. Every week we're now going 230 issues there. I like the process, and I like to exposing myself. But why doing it? First of all, you have to do it for yourself because you have to get something out of it. So the process of writing and the creativity of it gives me a good feeling. I feel good about it. There's something gets out of me every week, and I create something that's positive by itself. Because people underestimate. You have to have a lot of motivation. You have to have something to keep going, because people say, oh, I will now be an Instagram whatever and post there every day, and then after a week they say, oh, it's a lot of work. So I don't want to do that every day. But on LinkedIn, I post on LinkedIn because of the community, because I also had my times where I ask myself, what the hell I'm doing here, why I'm doing that, why I'm bothering, who's out there. It's just ridiculous. But the thing is, out of the many people, if you stay and you form friendships and you meet people in real life, and especially young people approach me because of LinkedIn. So your age, and they want to learn more about investing. So I meet them. So that's a great thing, because you learn from them, they learn from you. And you're not only within your age peer group, so you travel the different ages, you travel different parts of society. It opens your world. Again, Charlie Munger, he never had his private jet because he said he wants to travel in a normal commercial aircraft. And he told the story how he saw this Chinese schoolgirl learning on the plane, and he talked to someone. So through that he has experience. He doesn't want to be isolated, and we are all in a bubble. We cannot avoid it. But being out there, exposing yourself, you at least, yeah, I'm still in a bubble, but I'm opening it up, and I'm exposing myself to different things, and I'm also exposing myself to critique. I love critique. People that see things differently. So there's a lot in there to do it on a daily basis. Yeah, and there's certainly also some part also is vanity, no question.
What is a question that you are not often asked enough that you'd like to talk more about?
What I just notice is that whenever we have also client events, or I talk to clients or non-clients or people interested in investing, 90% of the time people want to tell me what they are thinking and be confirmed. Isn't it like this? And even if you talk about Berkshire Hathaway or Warren Buffett, where you really know a lot, and then people know a little bit and they want to tell me what they know and they want me to confirm it. So hardly anyone is really interested in learning. I'm joining every year. I'm going to Value X. That's an investor gathering. Now we're around 100 people, run by Guy Spear. He invented it. He runs it. It's a wonderful, wonderful event. And many people I've known for 10 years. And this is a very special crowd. I think there are a lot of people there. Most of the people there want to learn. They're naturally curious. They want to learn something new. They want to listen. But then if you notice there, that's very concentrated group of people. But if you go outside that, you notice that in the rest of the world, it's the opposite. Everyone says, I want to learn. I'm a lifelong learner. But the reality is they don't. In a conversation, they're waiting for the gap to say something. They are not truly listening to understand, to learn something new. And that's just astonishing to me. So I cannot extract the one question you asked me that I'm not asked enough, but it's a trait that I'm just so surprised. And I think there are more young people who are good at it. I mean, you're a good listener. You do it in your podcast. You're never interrupting the guests you have. You're doing it in a very good way. But I think young people, they have more sources available, and the smart ones use it and say, okay, what's really important in life, and then at some point they read, okay, you should listen, you have one mouth, you have 2 ears, a double time of listening than talking, blah blah blah. So they much better implementing in the life than my age peer group. So the older people, they just want to talk, they don't want to listen. So it's really astonishing. That's another reason why I like to talk to young people.
My dad has actually been really helpful in talking to me about this, because I'm naturally growing up, I don't know if you can get the sense, I'm bursting with ideas, and I'm really motivated and high energy, and really excited about lots of different things. And I'd say that my parents have always enabled that and encouraged me to go to good school and university and get a good job and really push myself. But particularly as I've got older, when I've had ideas for businesses I want to start or things I want to do, my dad has been really good at kind of, while still encouraging me to pursue those ideas and look at them and learn about them and research and talk to great people like yourself about them, at the same time he's asked me to say, Harvey, what are the facts? I don't want opinion. I don't want you to just say what's off the top of your head. I want to hear well-researched, evidence-based things that you say. Who have you spoken to? What's the actual fact about it? And it's taken me from, here's my idea that's in the back of my head that I've just come up with, to, here's the competitors. Here's what historically has happened. here's what XYZ person has said. And so it goes from this simple just idea in the back of my mind. He often says, Harvey, you're pontificating. I think sometimes he actually purposefully gets on my nerves so that I come up with these really evidence-based and justifiable arguments, because it takes you from, here's my idea, which I'm just going to say and you won't respond to actually, you know what, even that despite you not agreeing with my idea, here is why it is still a good thing to pursue. And I think that is something that has been really important for me to learn. And the second thing that I wanted to say, and I'm not trying to convince you of my ideas here, but I think is important in a podcast to do, is I think your idea of talking and listening is really important. It's so simple. I mean, I talk a lot, or I think a lot about these things with, when you're networking, send a polite email, send a follow-up email, try and be on time to things. I'm not always the best. I do my best, but I'm not always the best with these things. Be polite, listen to what people are saying. They're so simple. But the thing is that no one does them. 99% of people do not do them. That when someone actually does it, it makes them unique and differentiated. It's often just doing the simple things really well that lead to outsized results. And I appreciate you saying that as one of the most important things to you, because I think a misconception I would have had is big sophisticated investor, secret sauce, thinking about the world completely differently, when it's actually even someone like yourself is listening more than they're talking, trying to learn instead of tell, trying to do the simple things well, and also wanting to give back. And I think that's a really important thing to learn that I've had to learn over time.
Yes. And my wife says I'm too much into listening. I should talk more. She says, say something. So it also depends on who you talk to.
I want to ask 3 final quick questions. The first of which being, if I was to ask someone in 100 years' time, how would you want to be described and what would you want your legacy to be?
I think what I really enjoyed over more and more over recent years is the human connections I have. So the more people say, oh, Robert, oh, I remember him, I had some great conversations with him, or met him here or there, or even learned something from him, or whatever. So if I have some connection to a person, that's wonderful. And the more human connections you have, the better. So that's really something that I learned to appreciate. That's really super important for me.
My penultimate question, you can look at any time horizon you want. What's next for you?
I think I want to have more of the same. I think I'm in a great point in life where I've seen a lot, but where I can keep on learning. I mean, isn't it a wonderful profession? Part of your job description is to learn every day. If someone would look from far away what I'm doing, said, oh, he's studying something every year. He seems to be a student. So that's wonderful. So I have to have more of that. What really changed over recent years is the communication side. So much more communicating. I'm communicating to our clients what we are doing. I'm speaking to clients, meeting clients, but I'm also communicating on LinkedIn. I'm communicating with you and through that to more people that can listen to what I have to say and have a different opinion and come back to me. So I want to do more of that, and I want to become better as an investor. So me personally, I have not a good year this year, and I want to learn from that and see what I can do better for the future. So it's if it stays that way, I can do more of the same. I'll be a very happy man.
And my final question, I ask this to every guest on Personable, is what is one thing that you would want a listener to take away from this episode?
I think for me, it was a very different experience than it's normally on podcasts, because on one podcast I wrote about the Buffett letters out of the 50s and 70s. So often it's a very specific topic. Often it's very specifically on investment topics or some recent events or some features. But here we talk, your podcast called Personally. It's really much more far-reaching, and I enjoyed it very much. Not only sharing my experience, but I think it's always in a conversation with you giving your experience, and then I'm riffing on it, and you riffing on mine. So I like that style, and I like the way you do it. I think that's a good way to go for you to learn, but also for your guests to reflect on their own stuff and be in a conversation with you. So it's not the one thing I can take away, but I will definitely listen to our podcast, because also another strange thing is, if you're on a podcast and you're concentrating and you want to tell something, and then after the podcast is finished, you say, oh, you can't remember, and then you listen to it and say, oh, we talked about this and that, and I think there's a lot of stuff in there, and where you pick then out some stuff and go deeper. Some people say I never listen again to myself, but I like to listen to this conversation, because it's going by in a rush and I cannot really reflect on it. I have to listen to it again.
You actually kind of gave me a little light bulb moment because I have done perhaps 115 podcasts at this point. And before I started the podcast, I essentially ran a program in high school where I'd speak to great individuals like yourself, both in terms of investing, hedge fund managers, VCs, and then similarly in an entrepreneurship society, or I speak to CEOs and founders. Like I had former CEO and founder of Deliveroo, Ocado, Manchester United and Chelsea. And on the other hand, I had global head of research at Citi, top execs from like Goldman Sachs, JP Morgan. I had founders of VCs and hedge funds. And so I'd kind of get these really good experiences from people and then bring that down, start the podcast because I noticed there were commonalities between a lot of these different people from different backgrounds in terms of their learnings, their lessons. And so I dissected that through school and so wanted to make a podcast out of it. But actually the reason I made it more broad and made it not just entrepreneurs and investors is because I thought that whether you're an actor or you have a building company or, you're an athlete, I think there are things that we can take from them as well. But I think something that I've fallen into also ties into your idea of listening versus simply talking is the concept of what you pointed to with Charlie Munger, where he is this smart individual, works with Warren Buffett for years upon years. They have their investor meetings, everyone's listened to them, everyone's like, whatever they say is the thing that we listen to. But he avoids private jets, goes on a commercial plane, learns something just simply from how a Chinese schoolgirl is doing her math or whatever it may be. The reason I mention that story is I think that through my podcast, despite having learned from such incredible people, I think that I've fallen into a bit of a trap in my own head where I've thought that because I've spoken to 100 amazing people, they must all be doing the same sort of things. So I hear a lot of people say, listen more than you talk. I hear a lot of people say, be disciplined. I hear a lot of people say, I had a mentor. But, correlation isn't necessarily causation. And I think having done this podcast where I think that you've brought up a lot of different lessons that I hadn't previously thought of, it's reignited that light bulb within me to realize that all of these great individuals, yes, they might have things that make them the same, but it's also the things that make them different. That is the thing that I want to find because I think that is the guiding light bulb that will enable my listeners to become the best that they can be.
Great. Can only say amen to that.
Well, thank you so much. I mean, even with that little bit that I added on the end, I truly do believe that I've learned a ton from this podcast. I'll listen to this as well. I love listening back because, as you said, we're kind of focused on, the front of our head, what we're saying, but actually in the back, we can go back and listen. I feel I learned a lot about your passion for investing, why you got into it, why you went about simply going from being in the market and wanting to get short-term gains to actually going in there for longevity, about the realism element that even the best investors in the world can go down from 100% to 30%, to develop a fee structure, as pointed with your friend, where you're earning money even in those off years so that you can keep going with your fund, to constantly be a learner instead of just telling people what you think, to look up to greats such as Warren Buffett, to write and to share your knowledge because it puts you out there to be critiqued, it puts you out there to meet amazing people, puts you out there to learn amazing ideas, also can help in terms of building and maintaining your network, getting new clients, also meeting new and incredible people. But yeah, so thank you so much for coming on the podcast. I've learned a lot. I'm sure my listeners have too. You've reignited a light bulb, a fire within me for these podcasts. So thank you so much for coming on today, Robert.
Thank you, Harvey. Thank you for inviting me. I'll be super excited to follow your path, what you're doing in the future. I'm so sure that you will find your way and you do great in the world out there. But I'll follow you and I'll learn from you. Thank you, Harvey.